number which might be coming to your mind, you have to correlate yourself with the present situation along with the resources available for the same. For example, a person earning 1 lakh, if he's targeting like 100 crore portfolio, that seems to be a little bit real unrealistic. Similarly, a person who is having a less sources of income at present and wanted to go for a high risk assets can also needs to once again relook at the same criteria. So basis this, all these factors needs to be clearly defined while setting the goals for the same. When setting investment goals, it's important to consider your time horizon, risk tolerance, investment understanding, and other aspects that may impact those goals. As I mentioned that some of the asset classes are good in the long time horizon but might be unpredictable in the short run. So given your time horizon or the goal setting time horizon only, you would be able to allocate proper allocation. One needs to use different investment strategies for short term, mid term, and long term goals. Understanding the risk, the most important part of any of the portfolio, the risk. Risk is what is risk? Risk is defined as the likelihood that the actual outcome from an investment will differ from the expected returns. When creating a portfolio, an investor should understand what risk factors come with each type of asset, as well as any unknown factors that could also come into play. Risk is something which you are not quantifying while setting your portfolio or while setting your goals. So this is what something nobody can quantify. Only one can assume it that this could happen, that could happen. So there are two. Other than this, there are two important things which needs to be considered while risk profiling. Why we are asking for risk profiling? Because that will give us a sense to match the features of a particular asset class with the objective and the current profile of the present person. So first is the willingness to take risk, and second one is the ability to take risk. What are those things? Willingness is like you might be willing to take a higher risk, but your ability might not be there to take the same. Taking an example, for example, suppose I being a I mean, my parents are supposed dependent upon me, and still I wanted to play into a higher unpredictable asset class like uh, cryptocurrencies. So my willingness is could be high, but my given the responsibilities, my ability to take risk is very less. So these two things needs to be coincide with each other to have a proper asset allocation. Risk management. Once again, even though we understand the risk management is something, because every asset class have got a different risk, starting from a GSEC bond or a fixed deposit till any of the asset class like equities or alternates, you will find some kind of risk. So the same can be managed. It's not that every risk is unmanageable. There are some risks which are manageable, there are some which are not manageable. With the proper risk management, one can mitigate or lower down the overall risk of the portfolio. So risk management is the process of identification, analysis, and acceptance or mitigation of uncertainty in investment decisions. Risk is inseparable from return in the investment world. As I mentioned that every asset class has got a risk on its own, but the same can be managed with the help of some tools which are like fundamental and statistical parameters. For example, while choosing a debt fund, there are n number of options into the market, but if you want to be on the safer side, you don't want to do any kind of corporate risk, what happened with DHFL or what happened with Yes Bank. So credit ratings helps us a lot to understand the same. That will give us an insight that suppose a bond which is 100% AAA rated is far more safer than a bond which is like a AA minus or a A rated. Why so? Because that carries us a little bit higher returns, but that higher return is coming with a huge capital risk. So anyone who are able to quantify this prior to investing, like credit ratings, the allocation towards which as I mean which products the fund is investing, then that can help to manage the risk very well. Secondly, the liquidity or cash flow management. Some of the funds comes with a good tenure of lock-in, like the close-ended funds, FMPs. On the other hand, some funds are open-ended but provide the same features like the FMPs. Nowadays, for example, we have SDLs. SDLs in all the way are far better than FMPs, because the major drawback for FMPs is that you don't know the portfolio prior to investing A, and the second one is that you cannot exit even if you have a liquidity requirement. So nowadays our financial markets are also innovating itself to come up with such kind of mitigation with the help of the introduction of new products. So liquidity and cash flow management is also very much important, because you might be into a good investment, but if you have a mid I mean during the tenure of the investment, if you have liquidity or cash flow requirements, then you also have to consider the same while choosing the product. And the last but not the least, which is the diversification across multiple asset classes, which has a low correlation. Why we have mentioned this? Because when there are majorly two asset classes which have got a negative or a low correlation. One is equity, another one is debt. In between these two comes the commodities. Why I'm saying the same? Because commodities are, on the one side, it is a hedge against inflation. So in a rising inflationary scenario, the equity markets tend to underperform. Then commodities provide some kind of cushion. But at the same time, when there is a recession in the market, then commodities also tends to go down. So, but fixed income is something which will keep on, which are not related with or correlated with the equity markets largely. I would not say zero correlation or a negative correlation, but yes, there is a very low correlation between equity markets and a debt market. So proper diversification can be on the multiple asset classes, can be on the, there are n number ways of diversification, like country diversification. So we have global exposures, like asset class diversification, like we are having alternates, commodities, bonds, and equities. Similarly, we could be diversifying across multiple funds. So that is why we should not rely upon a single fund manager for any kind of performance, and so on. So diversification is the first and I mean, most of the important uh, criteria which one should do, which can help to manage the risk of the overall portfolio. Now, the strategies to follow. There is no holy grail to define a unanimous strategy to build a strong and efficient investment portfolio. Why so? Some, because every individual has got a specific and a different profile, different requirement. So a single strategy cannot be implemented into all the investors, right? So that is why the points which we just discussed now needs to be considered before choosing any kind of portfolio allocation. Other than this, some important points to be considered while building the portfolio includes risk involved, as I mentioned, that whether the risk is credit risk, market risk, or any other regulatory risk. Cash flow, liquidity, whether the funds are providing any kind of cash flow or not, whether the liquidity is available if anyone wants to exit or not. Taxation, the most important thing. Most of the investors sometimes, they might come up with a well efficient portfolio, but sometimes they miss the taxation part also. For example, fixed deposit versus some of the uh, good debt funds. So debt funds provide indexation benefits, but fixed deposit doesn't provide the indexation benefits. Due to this, most of the fixed deposits tend to underperform the triple A rated debt funds on a post tax basis. Because in a rising inflationary scenario, just like right now we are into a rising inflation scenario, indexation helps you to reduce the net income from the debt portion of the investments. How it, just taking an example of the same, suppose a 10 year GSEC is at say 7%, at the same time FD is available at 7%, and the investor falls under the 30% tax bracket. In that case, what will happen is that indexation and inflation is at say suppose 5%. So you are going to pay, after 3 years of indexation benefits, you are going to pay only tax on at the rate 20% on the 2% of the alpha which you are generating over and above the inflation. So 7% minus 5%, that works to 2%. So you are going to pay 20% flat rate into on the 2% alpha which you have generated over the inflation. But in case of fixed deposits, you have to pay the 33% tax on the whole 7% interest which you are getting. So taxation is also one more thing which needs to be considered while choosing any of the investments. Regulatory risk. For example, right now, most of the investors are like very much attracted with respect to cryptocurrencies, but there is a huge regulatory risk present over there. This is, first of all, this product is not standardized, the product is not approved completely by the SEBI or other regulatory bodies of India, and at the same time there is a huge taxation. There is no guarantee from any of the regulatory body that whether there is a counterparty risk or not. So these kinds of regulatory, and at the same time high tax rate is being implemented on the product. So regulatory risk is also very much important. And the lastly, the cost involved in managing the portfolio. As we know that some of the funds have got higher managing expenses. At the same time, some returns are linked with index, some returns are linked with your profits which you make. So depending upon the uh, cost involved which you want to pay, at the same time the rationale behind the same needs to be configured out before choosing any kind of funds. So, but these are only the basic strategies. One should need to go through the thorough process of understanding the product well, and then only take the decision to invest into the same. Some of the common mistakes which a new investor or a novice investor commits while creating a portfolio, which includes like FOMO, fear of missing out. If you suppose in your surroundings anyone is doing crypto, anyone is doing other speculative bets, then you might also get attracted because he is making money. No, you should not follow the same. This fear of missing out should not be uh, the criteria through which you take your investment decisions. Non-verified posts and suggestions. Right now social media is very much active, and someday you will find some WhatsApp message or a Twitter message like that Axis Bank has done something wrong, and you started panicking with respect to redemption of the funds. No, first have to you have to go through the uh, press media or the relevant SEBI website or financial website to understand the proper reason for what you're getting in the news flows. Then only you should take an action. Thirdly, the herding effect. As I said that when other everybody is buying equities, then only you should buy the equity. No, your rationale should be different from the others depending upon your time horizon and the risk profile. Gambling and other betting apps, nowadays a lot of gaming apps have come into the platform, but they are not regulated, they are not uh, there is no counterparty guarantee from any of the regulatory body. So with that perspective, investors should be cautious about the same and any other unregulated instruments, because a lot of ideas keep on coming day by day. So you should be with a SEBI registered uh, investment product as well as market regulated product, so that uh, none of these effects or noise should affect your any trading or portfolio building decision. So to overcome all the hindrances which I just discussed, you should consult a financial advisor who will be helping you a lot in deciding the proper allocation or to build a strong portfolio for yourself. So he will be able to evaluate the risk profile, then he will consider your investment objective. He will find out the best investment opportunities, whether it's a simple opportunity or a complex one, but he can present the same in a very simplified manner to you. And he helps to build not only a diversified portfolio, but at the same time he would be able to help you in tracking the same. So review and rebalancing is also a very important factor for any of the portfolio management process. So constant review and rebalancing needs to be done with each and every asset class at a different multiple time multiple, depending upon the news flows or the economic scenario. Thank you. Yeah, we are up to take the questions.
Hi everyone. Request you all to ask your questions regarding portfolio building. Keshav will answer that.
Yeah, as I said, there is a question that which is the best strategies to implement in the equity markets. So, as I said, that there is no predefined single strategy which is good into the equity markets. But yes, there are many parameters which needs to be looked out for whenever you are participating in the equity markets, like the current economic scenario, outlook of going forward of the market, I mean economy. At the same time, the valuations. The valuations are also very important while entering and exiting the markets. So, to give a short answer, there is no particular strategy defined, but yes, there are strategies which is applicable on